Hey Dale, can you hear me?
I can hear you,
Oh,
Peter.
good, good.
Oh, okay,
Uh,
great. Can you
Yes,
share
yes.
your screen?
Yeah, you
Steve's
can
going to
see him,
hand it
right?
over to you. Thanks for
There
your
he is.
patience, and Steve, thank you so much for working out the kink.
There it is.
Okay.
I passed him the screen as well,
All right,
folks.
so all you have to do is use the drop down, Peter, to share your screen, and we're ready to go with so many things to talk about. Welcome back.
Thanks
And
a
I was
lot,
gonna,
Dale.
I was gonna start with Nasdaq. So, really, Peter, I just want to introduce you to the crowd. I've been interviewing Peter Goodburn for, I think, at least maybe 5 years now, going back to the FX Street LAR days. And Peter's made some amazing forecasts. So, and I remember a lot of them, even if like 3 or 4 months pass before we talk again. So I could see what you're showing here right now, Peter, is
Mhm.
a question I've been getting. Okay, people, even people who aren't in the business, people that know me, know, I'm kind of a bearish guy. So, they turn on the news, brother, and they go, oh, the Dow's down 1,800. So I'm getting phone calls, and people are asking me, Dale, is this, the beginning of something? And I was telling people yesterday that I thought it was just a top, not the top. So that's a question I have for you, and your charts seem to show that we might have some more left, but we could first trade down under 6,000. Is that what we're seeing here on the Nasdaq?
Yeah, that's right, Dale. Thanks anyway for bringing me on your calls today, because I mean it is timely, isn't it? I mean we've had a big drop yesterday, and of course everybody's interested in seeing where we go from here. I just thought I would go back a stage further before we take a look at some real-time stuff,
Okay.
and go back to this particular chart, which was dated April 16th, because it holds clues as to why we're seeing, a decline like yesterday. From an Elliott wave perspective, of course, we're looking at pattern structure, but here at WaveTrack International, I like to use a lot of fib price ratio techniques, which I've developed in the last 25 years, to try and pinpoint down where these exact turning points might come from. Also, just to define a pattern. Actually, it's not as easy as you think. I see, a lot of general mistakes being made just because a pattern is being misconstrued very easily.
You bring up mistakes, Peter, and none of us are perfect, right? None of us are right all the time. And I remember, I think it was back in June, we had a 5-wave decline before we made one more high, or maybe 2 more highs in NASDAQ. And you were pretty convinced, because it was a 5-wave decline, that, we were on our way to targets that you're showing here. But unlike a lot of people that probably would have had to wait for that high to be taken out to be proven wrong, that midstream, what was it midstream before NASDAQ made another high you said 7620 was next, I heard, and then eventually 7700. But when an Elliottician is convinced, because they get a 5-wave structure that tells them there might be a trend change, and that turns out not to be, what was it on the advance after that initial decline that told you you were wrong and there are new highs coming? I'm curious.
Okay, well let's address that. First of all, the overall structure from February was considered to be an evolving zigzag, 3 price swings up. The idea was that back in April we would make a higher high, and then the market would collapse in wave C, which is the 3rd sequence of an expanding flat, and it ultimately would break below the February low. So that was the model at the time, and we were fishing around trying to find out exactly where this final leg would begin to end. The 38% extension levels that we saw just now on that chart from April were taken out around this area here.
I see.
We started to break it around here, and then we got all this mess And this, I admit, was quite tough because you're not really getting any unequivocal confirmation at this point in time. There's no clean 5 decline, any of those pullbacks. Maybe this one in early August, late July, early August. That might have been a bit goofy, and I remember that quite well. But I have to say that if you're going to conduct Elliott wave at this level, you never rely on sort of analyzing one index like this, like the Nasdaq. You're going to be looking at a cross-reference, and I always do. So
was it the Russell that gave you the clue because it was leading before the top, or was it the Dow? The Dow took over leadership for a while. Was it that?
Well, actually, it was the S&P 400 mid cap, and it was also the value line, which I thought was a broader measure of index. I can show you those actually. Let's take a look at, say, I've got. Let me just put a page number in here, and we'll take a look at that because. Okay, here's the 400 mid cap. Okay, the mid caps.
Okay.
And you get this very distinct. Let me put a pencil in here, and I'll draw it. But you get this very distinct 3 price swing event up from February's low. So you come up here like this, you pull back, and then you get this type of effect. And when you see 3 price swings and you're only just moderately breaking above a previous high like that, that's an alarm bell. You always must consider your Elliott wave default thinking must be zigzag for an expanding flat. It's basically training. It's almost as if you're going through the motions. You don't even question it. You just examine that pattern sequence and you say, okay, 3 price swings, break a previous high. Is it likely to continue? Or if it starts to fade, we've got the first signal. Certainly, if you start breaking back below that high, that's
it's like a false breakout to me. I'm not an Elliottician, but to me that would be a breakout failure. And those are some of your best trades because everyone gets wrong-footed. They buy the breakout looking for a big leg. What I have found is when you take out a big resistance level that has kind of a flat line of resistance and the market gives you 2 weeks to buy the breakout, be skeptical.
Yes, I mean, obviously, if you can see a very strong impulse pattern here from an Elliott perspective, this wasn't really strong, much stronger than this. One of my test periods for these types of things is doing something like this. We'll select a 61:8 ratio, and we'll simply extend the initial February upswing like this by 61:8. And normally, if you think like a third price swing sequence has developed below that type of ratio, and then it starts to reintegrate below the previous high, you know that's not necessarily a third wave because it just hasn't had the power relative to the first wave here.
Right.
Okay, and that's a very good proxy measurement. That will tell you whether or not there's some funny business going on, whether this is a sustained breakout which will eventually develop into a 5-wave impulse, or whether it's going to be a false breakout, as you say, and it will define a zigzag upswing rather than a 5-wave development. And
I'm curious, Peter, did the Russell give you a clue? As you know, a lot of people were piling into that because they felt it was a safe haven. It's really a joke, a safe haven because of tariffs, and it outperformed all the other averages, making new highs while the other averages were not. But that kind of had a false breakout too. It looked like it was a 4, kind of a triangle, and had one more thrust to the upside, and then back underneath the breakout, it just has really led the downside, don't you think?
Yeah. Well, actually, the answer to that was probably no. It didn't give quite as nice clues as maybe the S&P 400 mid cap.
Interesting.
And the reason being is because look at the movement up in from February's low there relative to that one. Now this one, whereas the S&P 400 mid cap was only marginally larger than this initial upswing, this one's actually stretched. It's what we call, it has what we call expansion properties. It begins to expand the price range. And that was a tough call because you could, looking at that in isolation, without comparing it to anything else, you could say, well, hang on a minute, that's big enough relative to the initial swing in February. That's big enough to be a third wave. And this could be just a fourth and a fifth. So in the last couple of weeks, since we've been seeing this high, we've been watching how the Russell has behaved, because if there'd have been a nice succinct 3 price swing decline, in other words, ergo a correction, we could have suspected that this was just a mild correction and it would start to run up. But actually, we've been telling our own subscribers in the reports in the last 2 weeks that this decline has got no clues whatsoever to tell us that it would be a correction, and therefore it would be likely to accelerate downwards. And if it did reintegrate back below the January high, this would be very bearish, and it would, even though it did have the qualities at one point to look like a third, it was big enough relative to the initial upswing. It really went back to bringing us to the fact that this would be still a zigzag, not a 1, 2, 3 pattern in a development to the upside in 5 ways.
Don't you think, Peter, guys like us that are always trying to figure out the jigsaw puzzle, regardless of the methodology, will not have to do brain exercises like a lot of older people do to stay sharp?
That's gonna, you know,
because we're always trying to we're always trying to put the pieces together.
We're never going to get dementia. That's never going to happen. No, we're far too active mentally to come on.
Yeah, so a lot of people would take their power of attorney away from me if they thought I had dementia. I might be way out in left field, but no dementia yet. So, I'm getting the drift that, almost every index that you showed before we resume the uptrend, we're going to clean out the February lows and create a lot of panic, and that's going to be a great buying opportunity that a lot of these pullbacks are for. Am I interpreting it correctly?
Yeah, no, absolutely. I mean, it does look like that. I mean, we can always hypothesize that actually this current sequence down is part of a triangle, in which case it wouldn't break the February lows. But I think it's way too big, this drop yesterday. It's looking very much more impulsive. This is the Dow Transports, by the way.
Okay.
And you get the same sort of impression. Look at this. Look, you got the initial upswing in February. You got a bit of a complex sideways there.
It didn't seem impulsive then. Yeah.
And then this is not really impulsive action. And it modestly took out the previous high. Started to drop down. It was one of the first to start dropping back below January's high. These are little clues. I mean, they if you're not doing it well, probably tough. But I mean, I know that
Go ahead. I'm sorry.
I know the advanced decline. The breadth of the market's been waning, but it's been waning since July. So that wasn't really a timing clue. But these are.
I know, because I was early on some bearish ETFs, so I wrote a lot of things out and added and everything. So do you think there's going to be some type of short-term rally because we're at some support levels here to possibly get on board?
Well, I was looking at the Nasdaq futures this morning, during the Globex hours, and I felt that. Let's take a look. I've got this is one of my worksheets that I work from before these go to production for our reports, but I'll show you them for what it's worth. And let's take a look. I think this is the short-term one I want to show you. And well, look here. This is the decline.
Right.
And I figured that this was 5 ways down, and I'm looking really for a correction. And I measure from that high.
Not the high of the move, but the high right before the crash. Okay.
Yeah, that's Tuesday, and this was, and you can see that if we put in some standard fib price ratio retracements, I don't rely on retracements so much as everybody else does, because actually I work with fib extension levels within the pattern that's developing. If it happens to coincide with some retracement, all well and good, but actually retracements for me are notoriously they're not so recurring as I'd like to think. But in this case, it's done a good job, because overnight you can see that the initial upswing is 3 price swings. It's hit the 23% area. Now that we've broken that, it should mean that we'll get up to here a bit later tonight or tomorrow morning, probably tonight.
Okay.
Yeah.
You know, I interview a lot of guys, and there was one guy saying that it was looking for a wave 4 in the NASDAQ to 6920 because that was wave 4 of lesser degree before another high. But that may have changed after we made a new high. I actually have an Elliott wave joke for you.
Oh, yeah, go on.
Okay, since, I mean, you know, you live and breathe it. Why did Elliott wave all the time?
Why did Elliott wave all the time? Yeah, go on. What's the crunch line?
Because he was impulsive. But don't worry, his wife was corrective. All right?
I like it.
Anyway, that's I made it up, so that's why it's not so great. But
Yeah.
anyway, you know, I'd like to move on. Kind of have the picture here. Great analysis of the indexes here, Peter. We all appreciate you edifying us. But I do remember last time you were on, and there were still quite a few gold bulls around, and you had a very bearish forecast. I think you're talking maybe 1120 or 1050 into October or the end of the year. And you know, right now it looks like it's trying to threaten a little breakout here above 1208. I was thinking maybe 1235 to 1260 first before we head down again. Are you seeing that as a possibility, or we may just fail here from this 1208 level? But that was a great call.
Well, thanks.
It kept a lot of people away from the pain of owning gold shares and gold as well.
No, great. Well, thanks, Dale. I pulled up this chart. It wasn't too long after we spoke, and this was dated June 15th. And we started to get a breakdown, you know, from the secondary high. Don't forget, there was two very similar highs that we had this year. One was in January,
right,
at 68, and then this secondary one at 65. Actually, I modified back to the 68 level in January. A bit
I
later
remember, Peter, even back then, when a lot of people were talking about that we could get a breakout over 1365, and they had all kinds of measurements, 1450, 1500. You said, even if that does happen, quote unquote, I believe it'll be a false breakout. So even up there, when the market was very bullish gold, looking for like a bullish formation breakout, you were skeptical even if it would have happened. Really good call.
Yeah. No, thank you very much. The reason for that was because we had a lot of overlapping sequences from the original December 16 low, which was 1122.98 in this advance, and it seemed too corrective. Again, you know, if you look at an initial downswing, you can't see it here. Let's actually look at, before I leave this chart from June, I just wanted to tell you that the third wave low was measured down to 1157. We got to 1160.
Right. Yeah, in Asia, I remember that. Yeah.
So I just want to show you, this was based off some FIB price ratios that we use as a technique to develop a third wave where it would finish. And I just want to highlight that to everybody that's listening, because these ratios are very, very important. If you're doing Elliott wave and you like Elliott wave because of its predicted value and it's a forward-thinking sort of concept, you must try and learn and integrate some FIB price ratios to your work, because that will give you a pretty good idea whether you're on the right track or not. But anyway, let's take a look at gold. And this is my current goal, which I send to our subscribers twice a week. You can see now, actually, let's pull that one away, and you can see the bigger picture now.
Yeah, so you are looking for a rally towards 1240.
Yeah, this is the fourth wave rally. Now, that fourth wave rally is, you know, going back to that June chart. This is the fourth wave rally here.
Yeah.
This one here, originally from 1157 something, and here's the low 1160, just a couple of dollars away. But here's the fourth wave rally, and it needs to trade up to about 1240.
That would be equality from the first rally from 1160 was 55 bucks, I believe, and from the recent low at 81, that would take it to 1236, 1240 for equality. Yeah,
that's it. That's the equality ratio I have on this log scale. That comes in at 36, so that's just a few dollars away, correct?
Yeah,
that's perfect.
Correct. Correct.
And the other thing, I had another target, which is based off a slightly different way of ratios. Now, we do some back-forward ratio relationships, like reverse engineering. We know that ideally, this is you see, this pattern is a flat. Now, for those that aren't familiar with Elliott wave, a flat is subdividing 3, 3, 5. You get 3 main price swings, which begins the correction. Then you get 3 or 7 price swings up to reattempt the highs. So you have to watch to develop, to know whether this is a high or not. You have to ensure that this is overlapping. It's 3 or 7 price swings. If it is, you know there's going to be a 5 price swing event to the downside, something like this. So this is just basically a flat. Very simple, standard textbook stuff. Now,
yeah, it's interesting. It's going to stop at the lows at the end of 2016.
Yeah, that's it. So in theory, what should happen is it should run up here and stop there. So what we've done, some reverse engineering now, okay? So what we're going to do is we're going to take, we're going to put in a 61/8 ratio in here. And what's happening is that this 4th wave should stop at a relative point that would enable the subsequent 5th wave decline to stop at 1122, that horizontal low. So
right.
Now it should be a 61/8 ratio of 1 to 3. So first of all, we measure 1 to 3 like this.
Nice.
And then we simply add it, look at the bottom level.
Right.
I'm going to add it to 1122 and stop and click it to link it in. And that comes to 42 3/4. So we've got 36 on the equality ratio that you just suggested.
Right.
We've got 34.5, I think, is a 38% correction of wave 3. And we've got 42.75, which is based off this one, this reverse engineering process. So we've got a pretty tight range of probably something like $6 to $7 where this next upswing will stop, and then it will come down again, and we'll finish the conclusion somewhere year end or January.
Okay, great look. So why don't we go to something that it was interesting. Gold was rallying while the dollar was, still showed strength. We could either go euro or dollar. I do remember you had a dollar forecast that, depending upon at that time back, I don't know when did we talk, in June or July, you had targets possibly, there it is, up around 99. So but you think that this correction isn't complete and we could still trade, well, we did trade 93.48. So are we already on the dollar is going to move opposite to gold? So while gold's recovering, the dollar is going to be heading up towards 99.91, or because the chart on the right isn't showing October. Oh, okay. I see.
The one on the left is probably more succinct for this. This was done on the 26th of September, so it's a couple of weeks ago. But what I wanted to show you was how this correction down from 96.98 was developing. It's a 3 pricing event. We had a little 5-way structure down here to 94.44. And on this date in 26th of September, we recognized that wave V was unfolding into an expanding flat, and that this low at 93.82 was proportionately too short relative to the initial downswing from 96.98 to 94.44 to complete the zigzag. It was too short. We needed, if it had have dropped lower down to 93.48, 92.90, around this area, it would have enabled then the next sequence up to 99.90 to begin. But it was measurably shorter, plus the fact that when the decline unfolded from 95.73 to 93.82, we could see that it had several overlapping sequences, which was inconsistent with this being the completion of the zigzag from August high. So we knew that this was an expanding flat. This would trade up to about 96.04. Well, hey presto, last week, the high was 96.12, and we've subsequently started this drop now down to this original level down here.
That's right.
I'll show you the real-time chart now. So let's move across, and let's take a look. And now you can see that 93.82 level. Here it was. We had 96.04 as a target, got to 96.15, and bang, there she comes down. She's beginning this move now. Look.
Right.
Okay, so this decline, okay, for the moment for the dollar, this sequence here, it's about 3%, which will allow gold to trade up to our 1240 number.
Interesting.
Now,
okay.
When gold gets to 1240, we expect the fifth wave down to 1123, right?
Right.
And that's where this next swing up develops to 99.90. So this movement from 93.5, it's probably going to get down to 92.90, I think. But once we get down to there, we go up to 99.90, and that's going to be the fifth wave decline on gold down to 1123.
Right.
So these two are very much intimately linked, reverse correlation, of course, and that's being maintained, I think.
Okay, thank you for that. Excellent. I also recall when crude was in the 40s and 50s that you were looking for, you said the mid 70s were going to be quote unquote sticky. And it has been. You know, we had that one pullback from 73 or 74, and now another pullback from the recent highs. So curious what you're thinking about in the oil here, Peter. And that was because I know long term you have some astronomical numbers.
Right. Yes. Well, crude oil. What's happening with that and Brent is that let's look at this chart. Now we have to go back to the lows in February 16. Now, for anyone that's listening and hasn't or isn't familiar with our work, when we got to the lows in 2016, we saw what we called an event happen. We called it the grand resynchronization because we had all the commodity markets finishing their 5-year declines from the peaks in 2011 at that time, including oil. There was a fantastic 3 price swing event from the all-time highs, which was, well, I think, July 2008, when it was up at 137. We had a fantastic zigzag measurement down into that February 16 low. And we also had things like copper finishing its low. We had gold, of course, finishing its low at the time, maybe a month or so before. But basically, you look at that, and also the emerging markets finished their declines. So there was this major event happening, and it also coincided with the major markets, the major indices like the S&P 500 finishing correction declines at that same time as well. So we knew with a very high confidence and a very high conviction at that point that we would start to kick on upwards. And if I go back,
I could verify that because I remember you had at that time price objectives of 2740 or so that seemed crazy to me because we were trading under 2,000.
That's right.
We were about at the 1800 level back then.
That's right. And we felt that the inflation pop scenario, which we have had going since 2010, when the central bank started to turn the wheels, that this would ultimately result in some massive price increases right across the commodity board from this low. Now, the advance is taking the form of a zigzag. So we have wave A up here into the June high. B was a running flat. So you come down in 3 waves. Here it's a bit like, what we've just looked at the beginning of today's session when we've discussed how B waves break a previous high and then they drop back down again.
Right.
This one didn't develop into an expanding impulse and break this low, but it did come down quite a bit. And then we get wave C moving up. Now, we had 2 original upside targets. Once wave A was affirmed here as completing, we could then have some measurements for wave C. And what we do is we simply extend this by 61.8. And sometimes, if we go to a higher high in the B wave here, we can sometimes extend that by 61.8 to yield the completion of wave C. And when we go back to this high, which was in July, we thought, oh, hang on a minute. This is reaching very close to this number at 78.90. Could this be ending the complete sequence? And we weren't certain, but when we started to drop back down into this August low, we could see 3 price swings, and it was very much confirmed in the Brent. So we knew that the probability was that we would again extend this sequence up and we would then attest to this $88 area. And that's still in play today. Now, I don't think that we're going to drop down dramatically until we get to that number now. So whatever we do over the next month, we will still have to trade up here. I'm pretty certain of that. This upswing that you see here from August low, it's a little bit three-wave-ish at the moment. And I'm waiting to see if we can see some nearby support for oil and it to turn back up. Let me just put the short-term chart back in, see if I've got it. That was that chart there was the three-wave pattern on Brent. Look at this, which brought in the affirmation.
Yeah, Brent outperformed.
Yeah, it did. It did. It was really good call, that one. Let's take a look at. I need this other chart. Let's see where it is. This is it here. Now, I'm testing this at the moment to see if this week's decline is a three price swing event. Now, I had targets last week down to 71.66. Today's low was 71.63.
You better clean it up.
Yeah, I mean, if we start to break below here,
points, Peter, I'm canceling my subscription.
Good, yeah, you have every right to. Money back guarantees, okay? Money back guarantees. But you know what I would say is that if this gets penetrated, it's going to break the upside momentum, and I don't think I'll be coming out of my own long positions below this low. Now I may have to trigger that in the next hour, but I'll be quite happy to do so, because I think the risk is that this is another three pricing event that breaks the previous high, which is here. And it does a five-wave pattern, an expanding flat. And I don't want to be around for that bigger move. So I'd rather neutralize that risk. But you see, if it does drop down here a little bit, it doesn't affect the concept of still going up here afterwards.
Okay, got it. All right, so yeah, we're either three waves or it could be really sharp. That would actually probably add to the bear case in S&Ps, because oils aren't a big group, but I don't think it would be helpful. That brings me to, I'm going to ask you to stretch it one more time and give just a quick look at what you see for 10-year yields, because that seemed to have been the trigger for everything that's happening here.
Yeah, isn't it amazing? I mean, 10-year yields have been inching ahead. We've seen recently, the largest speculative short positioning in futures.
It was contrary to that, and it kept going. It shows you that commercials can be wrong.
Well, that's it. The thing about commercials is because they're a commercial position against a hedge, and therefore there's no significant leverage for them. A leverage makes all the difference, of course. They can sit there and eventually they will be proved correct. But how long before? It's a bit like a divergence in the breadth that we've had recently. How long do you wait? Those guys will eventually come good and the specs will lose their money. But how long before it happens? Now, I think it was a very important break above the May high. Now, I have to tell you that at the May high and this drop that followed afterwards, when I examined that direct decline, I really thought that was a five-wave impulse pattern. And and the best intentions given, that should have prevented a break above this high, but it did break above. So Elliott wave can sometimes let you down. You can blame the analyst. That's fair enough. If there's a very good reason to think that could have been three waves, then we put our hands up and say no, that was a misdirected call. But it has broken the highs. But the bigger impact here hasn't changed, and that is that all we're doing is prolonging this primary fifth wave that began from September last year. It's a five-wave sequence, and it happens to be the fifth wave within the course of the movement up from July 16. Now, I still think that this is coming to a completion around 336. This happens to be a 38% correction when we go back to the 1981 high, but it is based off a logarithmic scale, I have to say. I think there's a lot of resistance up there. And in the short term, I'm thinking that the yield can drop like this in a bit of a fourth wave subdivision before we get that push. But
yeah, maybe that happens with the S&Ps flushing Feb lows. A little
that's
flight
right.
to quality. So
Yeah, I mean, proportionately, this is a fairly small move compared to what we've seen on the S&P, isn't it?
yes, yeah, there was no flight to quality.
No.
So that's kind of saying that the bear market in bonds is real. Otherwise, a day like yesterday, you would have seen yields drop 10 basis points, 15 basis points in the old days. Now, the funniest thing I heard, Peter, in the last year on CNBC, the week before the drop in NASDAQ, the S&P was weak and the Dow was weak, but NASDAQ was flying, before it topped. And an anchor on CNBC said investors are buying the FANGs in a flight to safety trade.
Flight to safety. Wow.
I had to keep tweeting that. I knew we were so close when I heard that the FANGs were.
Actually, I wish I'd said it. Would have given good publicity, right?
Anyway, so I've been tweeting that the flight to safety trade and the FANGs have been under.
Where was he in the late 90s? Where was that guy in the late 90s who said that?
Yeah. Anyway, whoever those investors are, they're going to learn what safety is. What a great interview! What a great interview, buddy. Once again, you never disappoint. Do you want to show people how they could find you and your website and your subscription offers, etc.?
Thanks, Dale. I appreciate that. Yeah. Well, first of all, this is our main website, wavetrack.com. And one of our main publications is the Elliott Wave Compass Report. You can go here, subscription, and if you scroll down to the first block, you can see it. It's $39 US a month. So and you don't have to sign up for anything more than a month if you don't want to. And what you get is something like this. This is the Elliott Wave Compass Report. You can download it, or you can view it online in our special Elliott Wave analysis platform. And we publish this twice a week, and you can get the S&P, the Russell, the Dow, everything we've talked about today, plus a few extra things. And there's plenty of charts to view, and we put a lot of inserts in. And this goes out twice a week. So it would be great. If you're interested, then please sign up. We'd be loving to welcome you.
Yeah, one of the hardest working technicians I know, Peter Goodburn. And Peter, thank you so much for coming in and crystallizing some things for me to process in the weeks and months ahead. I hope pips rain down on you and all of your subscribers, and let's get back together in the winter and see how things are, playing out. Thank you so much, my trading warrior brother, for taking time out to edify the F.A.C.E community today.
Great, thanks, Dale. I really appreciate it. It's great to talk to you as always, and hope to do it again soon.
And don't forget my Elliott Wave joke. You could tell people, why did Elliott wave all the time?
I'm going to tell all my buddies, don't forget.
All right, buddy. All right, Peter, thank you so much. Everyone, that's a wrap. Thank you, viewers from investing.com. And we'll see everyone tomorrow to wrap up the week. TGIF and Trent from Forest Park FX will be with us if you have any questions about brokers. So again, Peter, thank you for your great work that you shared with us today. And thank you, everyone, for your attention. Remember, most of all, don't just count your pips, count your blessings. See everyone for the wrap-up TGIF tomorrow. Thanks again, Peter Goodburn.